I'm Jack Lee from Forward Business Sales and Acquisition, based in Sydney, Australia. We are a boutique firm specializing in B2B mid-market business sales across Australia. And today, I want to talk about something that most brokers got completely wrong, and it could cost you hundreds of thousands of dollars when you sell. If you're thinking about selling your business, I guarantee you, your broker has told you something like this. Your business is worth 3 times your profit. Clean it up, get your business ready, and we will find you a buyer. And look, that's not completely wrong, but it is dangerously incomplete. Because what most brokers completely ignore is your balance sheet. I'm talking about the snapshot of what your business actually owns or owe on the day it changes hands. Today, I'm going to show you exactly why this matters, what question you need to be asking right now, and 2 real deals we have worked on. One with $5 million in net asset, one with negative $1.3 million, and how the balance sheets shape both outcomes completely differently. These are real situation, real number. The names stay confidential, but the lessons are universal. Why brokers get this wrong? Most business brokers, and I say this with respect, are trained to sell like it is a cafe transaction. Find a profit, apply a multiple, find a buyer, and done. For a small hospitality business with no real assets and liability, fine, that works. But for a mid-sized business, a trade services company, a healthcare practice, a tech business, a manufacturer, the balance sheet becomes central of the deal, not an afterthought. Here are the questions you should be asking and demanding your broker answer before you go to market. Say account receivable. How much do customers owe you? It is collectible? Account payable. What do you owe supplier? Does that stay with you or does it transfer? Say director loans. Have you been lending the company money or borrowing from it? Both have consequences at settlement. Cash. How much is it sitting in the business? Is it working capital or is it surplus? Big difference. Interest-bearing loans, bank debts, equipment finance, line of credit. Do they get paid out at settlement or do they transfer? You need to know which. Asset finance, vehicle, machinery, equipment with finance attached. What's the residual? Who carries it? Every single one of each item affects your net proceeds on settlement day. If your broker isn't talking to you about this, they are flying by blind, and so are you. Let's talk about asset sale versus company sales. Here's the other thing brokers love to say. Just do an asset sale, leave the balance sheet with the company, keep it simple. And yes, sometimes that's right. But let me tell you what they are grossing over. In an asset sale, the buyer purchases a goodwill, stock at value, and equipment. The legal entity stays with the seller. The seller keeps the liability and any leftover cash. Sounds clean, but what if your license and regulatory approval are tied to your ABN? Changing that can mean months of reapplication costs and uncertainty. What if you have hundreds of customer contracts in the company names? Novating this, reassigning them to a new entity can trigger customer review and early exit. It's a significant effort to do so, and we have seen substantial customer loss as a result. What if there are R&D tax incentives tied to the existing company? Those don't transfer in an asset sale. What if there are franking credits or carry forward tax losses? In the company's share sale, a sophisticated buyer can price those in. In an asset sale, they are gone. And here's one more, and that almost nobody talks about. In a company share sale, certain liabilities don't have to be clear before settlement. Things like trade payable, supply term, even some accrued entitlement, they can stay in the company and be managed over time. That means that the buyer doesn't need to bring as much cash to the table up front. It reduces their day one capital requirement, and they can make the deal more achievable for the right buyer. In an asset sale, those liabilities stay with the seller. They need to be resolved immediately. That's a very different financial position for both parties at settlement. Now, We are not saying company sale is always the answer. We model both asset sales and company sale side by side with the number, with the risk, and with the trade-off. Then the buyers and seller decide. Our job is to give you a properly modeled decision, not a one-size-fits-all recommendation. Most brokers don't have the experience to get into this territory. We do, and we love it because when you get it right, it benefits both parties. Real example number one, surplus cash. Let me show you what this looks like in practice. The first deal, a service business with strong profits and very healthy balance sheet. Net asset of $5 million. And sitting inside the balance sheet, there are $3.5 million in cash. At first glance, that sounds like a great problem to have, but here's where it gets complex. Option A, extract the cash before sale. The shareholder dividend out the $3.5 million before going to market. The business sales leaner. Buyer pay for the operating business only. The owners pocket the cash, but that dividend is taxable income. Depending on the shareholder situation, you could be looking at significant tax, potentially at the top marginal rate if franking credit don't fully offset it. So the $3.5 million doesn't all land in the pocket. Option B, leave the cash in, sell the company inclusive of it. The buyer acquires the shares and the $3.5 million cash comes with it. The seller receives a higher headline price. The gain is subject to capital gain tax for the seller, but potentially with a 50% CGT discount. The share had been held over 12 months. The challenge to the after-tax outcome significantly, but the option creates complexity on the buyer side. Think about it. The buyer now needs to fund the purchase of $3.5 million in cash. They are already sitting in the business. Banks may not. They are borrowing money to buy money. Banks may not necessarily love that. Lenders start asking questions. Why is there so much idle cash? It complicates financing. It slows down your approval, and it reduces the pool buyer with the borrowing capacity to get the deal done. So leaving the cash in is not automatically the better outcome. Now you are comparing two different tax events and two very different impacts on the buyer's ability to transact. Income tax on a dividend versus CGT with a discount on a higher sales price. The answer is different for every shareholder. It depends on every marginal rate, their shareholding structure, how long they have held the shares, and what other income they have that year. We model both scenarios in detail alongside their accountant, so the shareholder could make an informed decision before going to market. That's what we do. We don't just sell the business, we architect the outcome. Real example 2, negative net assets. Now, let me show you the other end of the spectrum. The second deal, a safety and compliant business, strong revenue, loyal customer, essential service, 15 years in business, $400,000 in EBITDA. But when we look at the balance sheet, negative $1.3 million in net asset, high interest loan, credit card debt, staff entitlement accrued over years. On paper, it looked like a disaster. A lot of brokers would say, you can't sell this. Or they are pushed for a quick asset sale for a discount and walk away, and that's what they were missing. First, 500 customer contract. This business had a contracted client base in safety compliance, a non-discretionary regulatory service, real recurring revenue, real defensibility. Second, hidden value on the balance sheet. Tax losses valued at $200,000 at a 25% discount tax rate, and franking credit $100,000. Together, that's $300,000 in future shareholder value sitting on the balance sheet. There's a simple profit multiple completely ignored. Subject to continuity of ownership condition, those tax attributes could be assessed by the right buyer, and they translate into real money. How we handle it? We didn't default to one structure. We model both asset sales and company share sales and lay them out clearly for both parties. Under an asset sale, the buyer acquired the goodwill, stock, and equipment. The liabilities stay with the seller to wind down. But novating 500 compliance contract to a new entity That's not simple. Each contract carries notification obligation in a relationship-driven regulatory industry. That process creates real risk of customer loss, and the sellers walk away from tax losses and franking credit entirely. For some seller, that trade-off works. Here, that number shows a different story. Under a company share sale, the buyers acquire the entity, APN, contract, license, and all. No innovation required, no customer distraction. The tax losses and franking credit remain accessible within the company. The existing trade, payable, and supplier terms stay in the business, managed over time, and not clear at settlement. This reduces the buyer's upfront capital requirements significantly. The negative net assets are a factor in the price, but the buyer is also inheriting protected revenue, reduced day one cash pressure, and $300,000 in embedded tax value. Represented both models, full numbers, full risk, full trade-off. Our view was that the share sales preserve significant more value for both parties. But that's a recommendation, not a mandate. The buyer and the seller make the final call. That's what it looks like when you actually work the balance sheet. So let me bring this together. Your balance sheet is not just an accounting document, it's a business sale. In a business sale, it determines what you actually net, not just your headline price. How the deal is structured and restructure work for your situation, whether the deal is even possible. If your contract, license, or liability make an asset sales impractical, what hidden value exists, tax losses, franking credit, surplus cash that a good advisor can surface and price it. If your broker is only talking about your profit multiple that hasn't opened your balance sheet yet, and ask them why. If you're preparing to go to market and want to understand what your balance sheet means for your outcome, reach out. No cost, no obligation, because the difference between an average exit and an exceptional one often come down to the detail most people never look at. I will see you in the next one. Thank you.